Okay, so in this video we're going to be looking at actually what causes the demand and supply for the Australian dollar, and therefore what causes the value of the Australian dollar to change. And as I mentioned in the last video, Australia has a floating exchange rate, which means that the forces of the market forces determine the value of the Australian dollar. So what does it mean to demand the Australian dollar? Well, that's when foreign currencies are being exchanged into Australian currencies. So when people, governments and organisations overseas want to buy our currency. So the main reason this would occur is if the foreigners are buying our exports. The more they're paying for our exports, the higher the value that we're receiving, and therefore the more money that's coming into Australia. So the more credits in the current account means more demand for the Australian dollar, and it goes up. Foreign countries lending to Australia, again, we're receiving money, so we will therefore, the Australian dollar will therefore go up. When our interest rates are high, it means that people overseas are going to want to put their money in their banks. They'll be more willing to lend to Australia because they will get a higher return. So when interest rates are high, there's more capital inflow and the Australian dollar will go up. Whenever there's investment into Australia, so when foreign companies invest in our shares, or people overseas invest in shares, or when foreign companies establish operations in Australia, that will all appreciate the dollar. When we receive income for our shares overseas, so dividends that we receive, I'm really just listing all these different things that are mainly credits in either the financial or the current account. When foreigners think our dollar will appreciate, they'll also invest in the Australian dollar because they think they're going to get a return. So there's basically what happens is there's more demand for the Australian dollar. That causes a shortage at the old price because supply will be here and demand will be here, and therefore the value will appreciate. If there's more supply of the Australian dollar, then there's basically going to be demand at this point here and supply here. So we will have a surplus just like we do in any micro diagram, and therefore the price will go down. Supply of the Australian dollar, again, any time that there is debits in any account. So if we purchase imports, if we give foreign aid to overseas countries, if we purchase assets overseas, then we have to purchase overseas dollars because that's what they're going to want if we're purchasing those assets. If Australians go up and set up businesses overseas, when we're paying interest on our debt, these are all forms of debits in the various accounts, and they're all going to lead to supply of the Australian dollar. If we pay dividends or give money on shares, so people who've invested in Australian companies, we have to pay the dividends on that. That will cause supply of the Australian dollar as well. So basically with the study here, think about what would happen in either the financial or the current account. If the transaction would lead to more credits, in either account the Australian dollar will appreciate. The Australian dollar will also appreciate if there's less debits. That's when it gets really tricky. So for example, if there's increased unemployment in Australia, that can lead to less supply of the Australian dollar because we don't import as much, because we don't have as much money, and that can lead to the Australian dollar appreciating as well. If oil prices are lower, we have to exchange less of our currency. That can lead to the Australian dollar appreciating because there's less supply of the Australian dollar. So there can be things that lead to less debits as opposed to more credits, which will also appreciate the dollar. If any factor will lead to more debits, so more importing, more foreign transactions, more money flowing overseas, then the Australian dollar will depreciate. This would occur if there's less credits. That should say credits. My apologies for that. So when we have if there's lower overseas growth or our terms of trade goes down, then there'll be less demand for the Australian dollar, and therefore it will go down as well. So here's a complete list of some of the things that would determine the value of the Australian dollar. So things that will cause the demand to shift to the right, so more demand for the Australian dollar. We're exporting more or getting higher prices for our commodities because there's more money being exchanged into Australian dollars. If Australians borrow from overseas, they're giving us money, the Australian dollar will go up. High interest rates in Australia, again, there'll be more demand for the Australian dollar because people will want to lend money to us. Australia sell assets or shares to foreigners, then there's money flowing into Australia. We receive dividends. If there's strong overseas growth, all of these things will cause more demand for the Australian dollar. Less demand, if there's lower commodity prices, we're exporting less. If there's bad productivity in Australia, we'll export less. If overseas countries are growing slowly, they will demand less of our exports. If we have low interest rates in Australia, there'll be less capital inflow. More supply of the Australian dollar. Again, this is more about what Australians are doing and how they're spending their money on overseas things. So if we import more, we go on overseas holidays, we're paying more interest and dividends and profits overseas. If we're investing in foreign companies, if Australians are setting up businesses overseas, if there's strong consumer confidence in Australia, because strong consumer confidence will lead to more importing. If we have low interest rates, then that's also going to lead to Australians wanting to put their money in overseas banks, so more capital outflow. Less supply of the Australian dollar. Again, high interest rates lead to less supply because less Australians will be putting their money overseas. Decreased oil prices, we don't have to pay as much for oil, so there's less supply. If there's terrorist attacks overseas, potentially that can lead to less tourism overseas. Low inflation in Australia will mean that we will import less because our products will be more competitive. Will also lead to more demand for the Australian dollar, but less supply. So they're the main things that will affect the value of the Australian dollar.